Welcome to Market Brief After Hours. Today, we are looking at a truly divided global market. On one side, we have U.S. equities hitting fresh all-time highs, fueled by corporate earnings. On the other, we're seeing deep anxieties across Europe and the U.K., driven by geopolitical tensions, naval blockades, and oil surging back above the $100 mark. It is a complex landscape to navigate, and we have a lot to unpack today.
It really is a tale of two markets right now. You have this incredible resilience in American stocks. But underneath the surface, the macroeconomic pressures, especially regarding energy and global supply chains, are building up fast. The extension of the U.S. ceasefire with Iran has provided a bit of a psychological safety net for Wall Street, but the physical reality of what is happening in the Strait of Hormuz is painting a very different picture for inflation.
Let's start with those U.S. equities, because the numbers are quite striking. Despite everything going on globally, Wall Street seems to be shaking off the geopolitical fears. Can you break down where the major indices landed today?
Absolutely. The momentum we saw today was heavily driven by corporate earnings. More than 80% of reporting companies are beating expectations right now, and that is a massive tailwind. The Dow Jones Industrial Average extended its gains, rising 0.69% to close at 49,490. The S&P 500 fully recovered its prior losses linked to the Iran conflict, gaining 1.05% to finish at a fresh record high of 7,138. And the tech-heavy Nasdaq Composite led the church, surging 1.64% to hit new all-time levels, closing at 24,658.
Those are incredibly strong finishes. But as you mentioned, that optimism doesn't seem to be crossing the Atlantic. Let's talk about the energy shock. We are seeing oil surge again, and it's feeding directly into European and UK economic data.
Exactly. Brent crude climbed more than 3% today to settle at $101.91 per barrel, while WTI rose to $92.96. The core issue here is the Strait of Hormuz. We are seeing severe supply disruptions in the Persian Gulf. Iran's seizure of container ships and the ongoing naval blockades have drastically reduced tanker traffic. When you choke off one of the world's most critical energy arteries, the ripple effects are immediate.
And we are seeing those ripples crash directly into the UK economy. The latest inflation numbers for March 2026 are out, and they are not looking great for the consumer.
No, they aren't. UK inflation has increased to 3.3%. This is largely being driven by transport costs and fuel prices directly linked to this conflict. To give you an idea of the pain at the pump, petrol rose by 8.6 pence per liter, and diesel jumped by 17.6 pence. But the most staggering figure is housing costs, which were pushed significantly higher by a 95.3% surge in heating oil prices.
A 95.3% surge in heating oil is absolutely brutal for households. What about the manufacturing side?
It's hitting them just as hard. Factory gate inflation accelerated to 2.6% year over year. When you look specifically at petroleum-related products, that surged 14.6%. It shows the direct, unavoidable impact of rising global energy costs on domestic production. Core inflation did ease slightly to 3.1%, but the underlying pressures across goods and services are undeniably strengthening.
That paints a grim picture for the UK. And looking at the broader European markets, the sentiment seems equally heavy. We saw widespread declines today.
Yes, European equities closed broadly lower. The Stoxx 600 was down 0.4%, as initial morning gains just faded away. The big story there is Germany. They effectively halved their 2026 growth forecast down to just 0.5% and trimmed their 2027 outlook to 0.9%. When the economic engine of Europe is sputtering like that, the whole region feels it.
And how did the specific country indices and their internal metrics look?
Across the board, it was a softer tone. France's CAC 40 fell 1% to 8,156. The DAX in Germany declined 0.31%. Italy's FTSE MIB dropped 0.25%. The UK's FTSE 100 eased 0.17%, and the Swiss SMI lost 0.51%. But the real concern is the fiscal pressure. 11 Eurozone countries are now exceeding the EU's 3% deficit ceiling. Belgium is leading that pack at negative 5.2%, closely followed by France at negative 5.1%. Italy's deficit did narrow to 3.1%, but that still keeps them above the threshold.
And I understand the labor market data out of the Nordic countries is adding to those growth concerns.
Precisely. Finland's unemployment rose sharply to 11.1%, which is the highest level they've seen since 2015. Sweden's jobless rate also increased, hitting 9.7%. And just to add to the inflation narrative, Iceland's producer prices accelerated to 8.6% year-on-year. So across Europe, you have this toxic mix of slowing growth, rising unemployment, and persistent cost pressures.
It really highlights the uneven global sentiment. Before we dive into the currency markets and some massive individual stock movers, we are going to take a very quick break. Stay with us. Welcome back to Market Brief After Hours. Let's pivot to the foreign exchange markets. With all this geopolitical uncertainty and shifting risk appetite, how are the major currency pairs holding up? I'd love to get a look at the technicals, especially the moving averages.
The FX markets are incredibly technical right now. Let's start with the euro against the dollar. Euro USD closed at 1.1705, which is down 0.32% for the session. What's fascinating here is that the pair retreated and landed exactly on its 100-day moving average, which is sitting at 1.1705. That is now acting as immediate support. Just beneath that, you have a very tight support zone formed by the 50-day average at 1.1663 and the 200-day at 1.1674.
So it's sitting right on a critical cluster of support. What happens if it breaks below that?
If it breaks below 1.1705, we likely see a deeper move into that 1.1663 to 1.1674 band. The pair lost upward momentum after being rejected near the 1.1850 region. But as long as it holds this moving average cluster on a closing basis, the broader trend remains moderately constructive.
What about the British pound? Given the inflation data we discussed earlier, how is GBP USD behaving?
GBP USD is holding firm, though it is losing a bit of momentum. It ended the session at 1.3501, down just a fraction at 0.05%. It remains supported above its key moving averages. The 50-day is at 1.3417, the 100-day is at 1.3455, and the 200-day is at 1.3413. So the medium-term outlook is still constructive. Immediate resistance is at 1.3535, but it's struggling to extend gains beyond the 1.3550 area.
And the Japanese yen? We keep watching this pair push higher and higher.
USD JPY continues its relentless march upward. It closed at 159.54, up 0.14% today. This pair is firmly in an uptrend and holding well above its moving averages. The 50-day is way down at 157.85, the 100-day at 157.03, and the 200-day at 153.61. There is just strong, persistent demand for the dollar against the yen, and all eyes are now on that massive psychological resistance level of 160.00.
Let's round out the major pairs with the Swiss franc.
USD CHF actually had a solid rebound today, finishing at 0.7848, up 0.58%. It managed to move back above its 50-day moving average of 0.7833, which signals a positive shift in short-term momentum. However, it still has work to do, as it remains below the 100-day at 0.7864 and the 200-day at 0.7934.
While we are on the topic of technicals and momentum, we have to touch on crypto. Bitcoin is making headlines again.
It is. Bitcoin broke above $78,000 to hit a fresh monthly high. The risk sentiment in U.S. markets is definitely spilling over into crypto, alongside continued institutional demand from ETF inflows and corporate buying. What really accelerated this move, though, was a massive short squeeze. We saw more than $330 million in short liquidations, which is driving price action right toward the key $80,000 resistance level. If it pulls back, $75,000 is the first major support, but a break below that could expose a drop down to $59,000.
And I imagine crypto-linked stocks had a good day on the back of that.
Very much so. MicroStrategy, Galaxy Digital, Riot Platforms, Coinbase, and Mara Holdings all posted solid gains today.
Let's move into our market mover segment. We had some massive swings in individual equities today. GE Vernova really caught my eye.
GE Vernova was a standout. Shares surged nearly 14% today. They reported first-quarter revenue that completely blew past analyst expectations. That really contributed to a broader rally in the industrial sector.
On the flip side, ServiceNow had a very tough day. What happened there?
ServiceNow sank 12%. The company actually came out and noted that tensions in the Middle East had a direct negative impact on their subscription revenue growth. It's a perfect example of how these geopolitical risks aren't just macroeconomic theories. They are actively hitting corporate top lines.
Boeing has been in the news constantly for all the wrong reasons lately, but their stock actually had a decent session today.
It did. Boeing climbed 5.5%. They reported a first-quarter loss, but the key here is that the loss was less severe than Wall Street had anticipated. In this market, sometimes just being less bad than expected is enough to trigger a rally.
And what about Sonoco products? They took a massive hit.
Sonoco tumbled more than 16%. It was a rough combination of missing sales estimates and then forecasting their full-year earnings at the very lower end of their previous guidance range. The market punished them heavily for that.
Finally, we have to talk about Tesla. They reported after the bell today. How is the stock reacting in extended trading?
Tesla is gaining in after-hours trading, up more than 4%. They actually missed on top-line revenue, but they managed to beat profit expectations. Investors are rewarding the margin preservation and bottom-line beat, looking past the slight revenue miss.
It really is a fascinating environment. Record highs in U.S. equities, strong corporate earnings, yet we have oil surging, European growth stalling, and inflation rearing its head again in the U.K.
That is the defining tension of this market right now. The investor appetite for risk is clearly intact, but the underlying vulnerabilities are becoming much more pronounced. The next few weeks will be critical to see if these geopolitical tensions ease, or if they begin to materially drag down global growth and force central banks to rethink their inflation expectations.
A lot to keep our eyes on. Thank you for that incredibly detailed breakdown. If you find this useful, please follow Market Brief After Hours.